Welcome back. Interest rates have been rising. The 10-year Treasury yield striking a multi-year high this past week, hitting 3.1% at the high for the first time since July of 2011. Should investors fear bonds just because yields are rising? I'm joined right now by Grant's Interest Rate Observer editor, Jim Grant. Jim, it's always a pleasure to see you.
Well, thank you, Maria.
Thank you so much for joining us. First off, your thoughts. I mean, this market gets so afraid of 3%. Your thoughts on where Treasury yields are going?
Well, I'm guessing, underscore guessing, they're going higher. These interest rates tend to trend in really long cycles. I mean, they declined for the better part of 35 years until July of 2016, and before that, they persistently rose for 35 years until
Incredible.
1981.
Yeah.
So just maybe we are embarked on a lengthy cycle of rate rises, although nothing about that says they have to rise quickly. But you're not getting paid that much to lend to companies or to governments. The U.S. Treasury 10-year yield is at 3.10, and we all kind of draw in our breath and say, 3.1%.
It was negative just a few years ago.
So old am I, Maria. I remember when it was like 5%. In fact, I remember when it was 15% and up. I don't think the 3% number itself is especially frightening, but what it indicates, I think, is that the era of predictably low and lower rates is perhaps over.
Do you worry that the Federal Reserve blows it in this environment? They're talking about raising rates 3 times for 2018, possibly 4 times. But this is unprecedented given the balance sheet that they've got to unwind. $4.5 trillion.
Remember this Mike Tyson line that everyone used to recite, everyone's got a plan until he gets hit, said
right.
Mike Tyson, right?
Everybody has a plan until you get punched in the nose.
Right. And the Fed has a plan, and that plan is to raise its little tiny federal funds rate 3 or 4 times this year. But what if things don't go according to plan, as sometimes happens in life? What if, for instance, the emerging markets submerge, or what happens if Italy steps in front of a bus, figuratively speaking, and there's a euro crisis, or and so forth. So I think that the chances are the Fed is not going to follow through on its plan. The Fed would like us to know that it is no longer prepared to flinch in the face of a falling stock market. I think that the Fed would flinch in the face of a falling stock market. So I think it's rather unlikely the Fed is going to just do what it has, stated it is going to do. I think things are much more in flux.
Do you think we will see a serious sell-off in the stock market?
Oh yes, and I've thought that for a time. What these low rates have done is to flatter earnings and projections of earnings. A very low interest rate discounting future cash flows flatters those cash flows. Rates this low have allowed companies to refinance at very advantageous rates. They've allowed the layering of leverage, thereby also flattering earnings, expanding them. But I think that particular phase of our financial cycle is ending. I think that the bond market is going to become not a source of comfort to the stock market, but rather a problem.
And how significant a sell-off would you expect in equities?
Oh, I don't know. I
mean, you created.
But allow me to say that
yeah.
Sell-offs are fabulous in that the real money in one's investment career is made in times of adversity, when things are compellingly and astoundingly and, underscore, terrifyingly cheap.